very bullish on the recovery in the US space, and I want to test that somewhat with the recent news flow. Given the likes of Alcoa disappointing, we had JP Morgan coming out with numbers that also disappointed, specifically where the consumer is concerned. We had losses where credit cards are concerned and where mortgages are concerned under pressure. And then we had obviously the retail sales and consumer confidence out of the US space last week, also disappointing. So some mixed data. Your view, though, we're in a healthy recovery.
I think, Bronwyn, the recovery, the base is forming. I'm not saying we're into a massive reflex in terms of the data, but I certainly see incremental improvements throughout the year. I think that's important to take into account. I think if one winds the clock back to October of last year, we were looking over the abyss, and I think if one looks into what's happening now, there's certainly been a coordinated recovery in the US. And if you look at the cost-cutting measures that have been put in place in the US, we think the S&P earnings cycle is going to exceed expectations. There's a lot of gearing in the earnings in the US, a little bit of revenue growth, really trimmed up companies. The US have been incredible in terms of the way they cut out costs. So you saw in the last earnings cycle, significantly beating the market and the street's estimates. We expect the earnings to be significantly higher than the market's expecting at the moment. So we expect good earnings coming out of the S&P. I think the question is the sustainability of the recovery, the extent of the recovery, and how long it's going to take. I think it is going to be a drawn-out recovery. I don't believe we're going to have an immediate V-shaped type recovery, but certainly we are going to have a sustained recovery in the US. And I think you bet against the US at your peril.
And against the US dollar at your peril, it appears as well, if you're forecasting 130 on the euro-dollar space at year end. Back into the local space, Richemont obviously has that global exposure, and in the luxury goods space, certainly surprising on the upside, a very good December. And as I was saying to Rico earlier, certainly it looks as though the luxury goods space has come back, but we did rally 72% on the stock over 2009, and you've got to wonder whether it is at fair value at these levels.
Yes, Bronwyn, I think the market started discounting a lot of the good news well in advance, but even this result showed that it had beaten market expectations. The stock reacted positively to it.
Yeah, we're up 2.5%.
You know, I used the comment earlier in our team today saying, China on steroids. In constant currency, the Asian Pacific region up 35% for the quarter. A remarkable performance. We've seen a reflex across the divisions in Richemont. Particularly encouraging was the unwinding of the destocking that we saw happen in the first half. People are starting to restock, buy an inventory, and that shows a confidence in the underlying consumer demand. I don't think it's back to the races for luxury, but certainly it's a very encouraging improvement in demand. If one looks at the sector as a whole, lost about, there was 175 billion euros in 2008, shed to 153 billion euros in 2009. That's a lot of sales lost, a lot of fancy trinkets, Bronwyn, gone. The habit of people wearing big flash watches, I think I use the terminology bling is dead. I think people are going to be a lot more circumspect in the way they spend their capital. But enduring luxury, enduring quality, something like Cartier, I think is here to stay, particularly for the super wealthy.